mechanism as we head deeper into the grand story that is our liquidity cycle. Okay? So, today we'll talk about what's going on with momentum. We'll talk about the runner. Again, we said yesterday that momentum was the most stretched it had been since October 27th. You saw that pullback yesterday, a little bit of weakness continuing today. As you can tell, I was talking about closed-end funds yesterday before I shut down my computer. As we look across the board at the moment, come on, you can do it. We're down a little bit. 5,800 cocoa, and interestingly enough, orange juice was rocking. What happened? That was the worst performer of commodities of the year last year. He would hope we could go contrarian long on some breakfast foods. It's not working out. Oh, well. Good morning, Ed Flowers. Good morning, Bangkok Dan. Bangkok Dan. All right. So, as always, why are you here? You know why you're here. What else are you going to do at 8:45 on a Thursday? Certainly not take my wife's lunch to her. Stocks that are worth engaging in today. We'll talk about the runner at 9 o'clock. Then we'll also talk about whether or not this market is safe to trade in or if it's a trap day. And we made that point yesterday that we were the most stretched on momentum that we had seen since October 27th on a 6-month rolling basis. That had lack of bidders. There's just the buyers got exhausted and there weren't anybody really selling. There wasn't any stocks that were breaking down, and that's kind of where you take that contrarian approach. You got to be a little bit cautious. But that said, we're smart money positioning today. We'll do some screens. We'll talk about stocks, and then we're going to talk about copper, the metal that the world can't grow without. Put that on a poster. Here is momentum for the broad market right now. Broad reading on the Russell remains green, 27 breakouts versus breakdowns. So that is our net number. Positive acceleration, 36 against 9. The NASDAQ is stretched, and there is no negative intersection at the moment. That is a little bit of cause of concern and why you need to be paying very close attention to the 8 and the 20-day moving average. Stress in the financial system. We have seen it in recent days with ongoing repo challenges. China just did a $1 trillion yuan reverse repo, but then still did net injections for repo. So money is being pushed into the system, but it's not as aggressive as previous, say, quantitative easing efforts. What we're seeing is support, and that's the key term, support. This is actually providing exit liquidity. It's providing support that spreads are not blowing out. It's enabling selling into Q1 if people want to take that option. We don't want to see blowouts and spreads on Mag 7 stocks. That would signal something much, much worse. But once again, as we look at this, the NASDAQ just continuing to trade sideways since we started to have those S&P 500, the SPY 688, again, same thing, right back where we were, October 27th, October 28th, October 29th. But this is not about the performance of the S&P 500. It's about momentum itself, the number of stocks breaking out versus the stocks breaking down. This is where we were back before we started to have that repo spasm. And the Russell just continues to show strength. Lots of rotation into smaller cap names. If you look at groups and you look by valuations, forgive me, that's wrong. If we look by groups and we look by capitalization, you could see the micro caps and the nano caps and the mid caps and the small caps have been the top performers, but not the mega and the large. So that's what people would call rotation if you want to. That are getting that bid. That was that list of stocks that I handed out last week when we were talking about F score, Graham score, and Z scores. Money pushing into these smaller cap stocks. We'll see how sustainable that is. It has been a very strong year for micro cap stocks. Top performer in the last year, beating out the small caps and the mid caps and the megas. And once again, as I've said, if you're looking at names in the small cap space, you're just looking for things, looking under rocks, looking for value. It's the things that are trading for less than their intrinsic value, less than their net asset value, because if monetary inflation continues, these valuations should, over time, become whole. Just continue to focus on these names and be turning your attention to the consumer defensive space as we move deeper in the year in the small and mega and or small and nano cap space and micro space. All right. Today, we've got a jobs report coming out. I don't care. I care about this as much as I care about, I don't know, Olympic volleyball. I don't care about Olympic volleyball. The key thing right now is we have a lot of other jobs reports, a lot of information, jobless claims coming out, JOLTS reports, challenger data. All of this is important because of labor softness. Now, again, I'm not going to prescribe to the importance of the jobs report. I've grown a little bit numb to it. But that said, just because I have my bias doesn't mean that the rest of the market is not going to react to it, and it will. There's going to be a lot of noise around this in the next 24 hours. And that's all well and good because the expectation and the question is, will the Fed cut rates in March? No. Will the Fed cut rates in March? Nobody. And I can't really, I can make the case for it, but I can also not make the case for it. I personally think, like the way to solve most of this problems is probably to cut interest rates to zero. Hear me out. And then you tax at the point of origination of new capital coming into the market. Right? Cantillon effect. Money is created. Broker-dealers get it first. Banks get it first. Tax it right there. Tax it right there. And then the reality is that when new money is created through rate cuts and new lending, ultimately the banks get it first. They have 20% advantage on inflation on everybody else. And then everybody else, it ends up as a line item. It ends up as an interest payment. They got to figure out how to actually heat map and track capital to determine whether or not, just how unequal it is. But if you keep interest rates low, that helps the back end. That helps the average American. But they're not going to think about that. It's too early in the morning for something like this to talk about fiscal policy. I apologize. Let's move on. Defense stocks. Rip higher, 50% military spending increase. Why not? Why not? I mean, we're printing the money anyway. Defense contractors rebounding sharply. Had a bad day yesterday. Are we going to get through a $1.5 trillion? How are you? I don't even know. I don't have enough breadcrumbs to get home on a return like this. But as I've said time and time again, it doesn't matter because the spending is always going to be there. The increases are always going to be there. There is no investigation into whether or not defense spending is ever. And why the richest counties in the country surround D.C., and it's largely defense contractors. So we moved them out of California and we moved them to D.C., and property values have not done anything but gone up. So looking at RTX, looking at LMT, I just keep saying the same thing. Every time that Lockheed gets down to 400, buy it. Every time that it rebounds up to 500, sell it. This could become a sell the news event today, largely on the back of like how much better is it going to get? We are talking about taking over Greenland. We have military intervention in Venezuela. We have 1.5 trillion potential spending in. How much better is this going to get? If you are in the defense and you are now moving toward overbought territory, sell calls on the existing positions. It's not that complicated, is it? All right. Our RCAT, Palantir, KTOS is fantastic. We are a huge fan of KTOS here. We have been long this for a very long time. We were recommending it back in the 20s. Kratos is Iron Dome, then the Iron, whatever the heck that we want to create here in the U.S. Look, that's really at the end of the day what most of this is about. This is why you want Greenland, because you want to be able to set up some of these missile defense systems that stretch from the Atlantic to Alaska. And once again, I keep going back to PANL. We were talking about that with Gianni. Arctic shipping. Imagine if we have all of our ducks in one row able to do Arctic shipping with PANL. Cool company, by the way. All right. Let's see. I got some quotes. I got some statements. I got some people saying some things. Have you heard and is collapsing? I can tell you that Treasury demand is struggling on the far end of the curve, but the idea that it is collapsing, that very specific term, probably not. That is not terminology that central bankers and Treasury officials would use. Just going to say. But that said, look, there are. I've walked people through how to monitor and measure this stuff. If you actually want to know if Treasury demand is collapsing, you can look it up. It's right here. It's on treasurydirect.gov. And it will tell you when the auctions are and what the individual rates are. And then you want to pay very close attention to SOMA, which is the Fed's account at the Treasury. Now, there we go. There's the 4 weeks. There's no way, I'm just going to point this out, there's no way that T-bill demand is going to completely and totally slump. And there's a reason for that, because it's literally free money. It's just capital. It's a cash like instrument that is ultimately utilized for the purposes of refinancing existing debt. Kevin O'Leary. Oh no, not Kevin O'Leary. That guy would never. You're gonna have to forgive my my skepticism of Kevin O'Leary at 8:58 warning me about Treasury auctions. NOC, LMT, RTX, GD, Boeing, ITA. All right. Wow. We're lively this morning. It is hard for rates to stay down, but it is not impossible if the Federal Reserve monetizes that debt. So let's just keep this in mind. What did Japan do? It's called yield curve control. What do? They print money and they buy bonds with their own money. We are at 120% GDP, our debt to GDP. Japan's at 250%. So I want to just tell you very quickly, if you sit here and you say it's impossible for interest rates to stay lower, it can go on a lot longer than you believe it can. I'm just telling you right now. We have been hearing over and over and over and over and over and over, this is it. And they find another way to create demand for treasuries. The basis trade is a trade created to synthetically create demand for treasuries. The stablecoin situation, the Genius Act to create demand for treasuries. They can force certain countries to own treasuries. They can force other countries into the dollar. There is a issue going on right now in Europe with the euro dollar. At the moment, there is a lack of collateral, quality collateral, which actually means you want more issuance on Treasury. But that said, you can't flood the market with 10% bills. That's what would create, or 10-year bills or bonds. That was what would create systemic problems. That's why they keep financing the government at the front end of the curve. And the front end of the curve, where the Federal Reserve is buying T-bills, is suppressing that yield. It's important. Okay? All right. AI slop. Cool term. All right. Let me get through these next two things. Then we got the runner, and then we got to talk about copper. The majors that want to potentially go into Venezuela want legal protections before committing capital to Venezuela. This is where it's going to get murky. This is where it's about to get real murky. So can the U.S. government provide these protections? Technically, yes. We've done it before with other types of projects. But the one thing that is critical about this is there's still a lot of geopolitical instability. The big focus here is going to remain on Chevron. Chevron's already there, 250,000 barrels per day. The key problem with Venezuela remains logistics. We got to rebuild pipelines. We have to make sure that we have ports set up. We have to be able to have the capacity at our refineries here in the United States. So it's not just, hey, like we're going to turn a valve on and all of a sudden this oil is going to be here. But the market is already starting to adjust under this assumption. I'm going to just simply point out that I don't have the best expectation that this is going to remain a sustainable thing into the deep future. And the reason for that is the 2028 election. I don't know who's going to win. I don't care. I just point the camera at it. That's my job. The thing that I just want to point out is that this is already setting up to be a potentially long-term issue. And unless there are demands and a clear plan in place, I don't see how an Exxon or a Chevron is going to commit massive amounts of capital to go into Venezuela when they have ample supply in other places around the globe, and they're going to be able to produce it there. Remember, Exxon has its own army, or it did, back in the 2000s. A great book called Private Empire by Steve Cole, if you haven't read it. Utterly fascinating book about Chevron, or Exxon. Copper shortage is intensifying. This is what we're going to talk about the last 10 minutes. I just want to point this out. S&P Global coming out. Copper demand's going to jump 50% by 2024, driven by AI. We've heard these warnings before, and when these warnings come out, this is kind of where we start to see a lot of more speculation. So I want to be very, very clear on this, that when we talk about copper and the opportunities that come, it's very important that you recognize that this is a trade. It's not going to be a fundamental investment. This is upstream copper production. It has the same types of challenges and the same types of problems, debt, investment, ESG, everything that comes with it, that a traditional oil company will. No, it's not apples for apples, but these structural bottlenecks are going to remain very critical. And the key thing to keep in mind is that these are complements to Chinese demand and Chinese stimulus. We'll break that down in a couple of minutes, but first, Secret Agent Charlie, where are you? Where is he? There he is. All at 9 o'clock. You gotta give me a minute, Charlie. Palantir. Look at this guy. Just straight up. What a silly little stock. Okay, momentum is strong. That's good. Momentum is improving. That's good. Money is flowing back into the Mag 7. That's good. And what's the FNGD doing? Well, the FNGD is now cracking below that 20-day EMA. We get under that 517. We get under that 505 level. Get under that 505 level. You get under that 505 level, I'm long Palantir. Palantir, a move back to 200, seeming like it is in the cards. What's the way to trade something like this? You buy at the 180, you sell at the 190. You buy at the 185, you sell at the 190, the 190, 200. Pretty simplistic, looking out into, yes, next week, next Friday. We're looking for a continuation of trend, and you keep a tight stop. Stock's moving higher today. You want to be a little cautious heading into the pre-market. You want to make sure that you bring out your 3-minute chart, and you also want to make sure that you bring out volume weighted average price over here at TradingView, or you can use it on Thinkorswim. Every time I try to use it on Thinkorswim, I don't know how anything works. You know that. So I stay where I am comfortable as a trader. And we look at PLTR. PLTR brought up on the old VWAP. Let's get out of there. Let's get out of there. If you need videos of how to set this up, we have them because we're so nice. One day, and then we go to 1 minute indicators VWAP, and it brings up your volume weighted average price. That's that blue line. Here is your first standard deviation, and then you hit the little gear, go to visibility, go to inputs, band 2, band 3 standard deviations, third standard deviation. If you are going to go long Palantir, well, you want to make sure that we are on the right side of volume-weighted average price, or you want to be down here. This is my favorite little place. If I'm long a stock, especially a stock that is in what is known as a bounce lag territory, look up Grant Henning. who does this type of analysis and momentum. What you're effectively looking for is stocks that are within striking distance of their all-time highs. And what do they do along the way getting back to their all-time highs? Well, they ebb and they flow, higher highs, higher lows. So we want to see a pullback to take advantage, full opportunity to potentially see that next move up. So if we start to see some selling to start the day and you remain long Palantir like I will be, I'm going to hope that we get down here into that second, third, fourth deviation. I will buy at the money, probably at the 185 if we're down here, and I would sell up around the 180, 187.50 or 190 into next week. eBay. Wow, look at this. I bought so much crap on eBay last year. I'm very excited about it. I got to sell some stuff on eBay. You want to hear something sad? I hope Brett's here. That is a Paul Skeens patch card. It's got a, I don't know, jersey card. Number 99 of 99. And I went outside the other day to pick up something, and it fell, and the corner went. So it went from a 10 to maybe a 6. Got to make that money back and buy the other ones. All right, eBay. Key thing here, looking for moves off this 8-day EMA. A little bit of a pullback this morning on eBay, but consumer cyclicals remaining strong. The challenge here is that this is coming out of overbought territory, so I feel like I missed it. And the buy would have been back here at 83 on that crossover on that 8 with the 20. So I'm a little late here, but eBay, higher highs, higher lows. This feels like a Professor Bierman stock. Let's see what he has to say about eBay today. We will put that on his lunch plate. And lithium Argentina. Look, I'm long all lithium again. Look, it's all about the metals and China and everything that comes with it. Remember, we had a huge pop earlier this year on Lithium Americas, LLC, and we've sold off and we've been shopping around. And these want to go higher because, once again, we're entering a phase of speculation in materials. I like selling put spreads on LAC. I like selling put spreads on all of these types of names because I want to own them for less. And these are strategic metals and strategic mining and materials, oil, energy, particularly as China engages in stimulus, all boats rise. So, LAC. Is eBay a put spread play? I'm not going to do anything with eBay. It's overbought. I don't want to do too much. Okay, weak side. This is a problem. That's your banking system. That's AIG. This is there's something wrong. I just want to point this out, right? We go back here, right? We go back here into December, right? A couple of moving parts. What has happened with AIG? This is November. This is where Japan printed. This is where the U.S. steps in and says we're going to buy $40 billion in treasuries a month or T-bills a month. Here's AIG selling off. Now, I want to point this out. Every time AIG is selling off post-2008, every time that it is selling off, there's a problem in the financial system. It is a canary in the coal mine. This is the ECB crisis. This is the Chinese crisis. This is the Volmageddon / trying to raise interest rates, COVID, gilt crisis, Silicon Valley banking crisis, interest rates / Japan, and now the most recent thing. So AIG selling off is a warning that something is off. And the other thing about this is that we talk about the FNGD. The FAZ is waking up now. It's gotten a little bit of a bid. We got to watch the DPST, which is the regional banking space. The insurance companies are going right now. Now, I don't know how or why this is the case, but we had a big move down in August. Repo had another big move in September. Repo had another big move down here in November. Repo. This is repo. I don't know what else the hell it could be. So I want to just urge some caution at the moment. The way that AIG is moving and the way that some of these other insurance companies are moving, it is a signal that something's amiss. A big bank has to be in trouble. It could be in Europe. I think it is in Europe, to be honest. But whether this is linked to silver or this is linked to repo or this is linked to just a lack of lending, just be on caution, because we did see the XLF start to panic a little bit yesterday on our hourly chart. Started to break down a little bit. This is where our attention needs to be for the next 24 to 36 hours as we head into the end of tomorrow. All right, so there's that. Caesar selling off. These are all just, cyclicals that are weak. A little bit of chopping. If we break back under that 50-day EMA, buy the $24 put and look for a continuation of trend to the downside, somewhere around 20. ARHS. Right here. Same thing. Under that 100-day, 1051. Move to the downside, $9 downside. Ooh. DFEN. All right. What's on the upside? What are we watching here? DFEN real quick, and then we're going to move on to some other stuff. DFEN. Defense stocks just continuing to roll higher. Nail. The housing stocks are running as well, or were running yesterday after Trump announcing what he had said about the Blackstone, BlackRock, private equity. Keep an eye on names like BLDR. They're selling off a little bit today. They had been under some pressure. And then on top of that, Tesla, which doesn't want to ever go away, it seems. Tesla continuing to break down a little bit. I'm going to just tell you this. We hit that 100-day EMA. Don't be afraid to turn around and go long. Contrarian long on Tesla at the 420 level. 420. Hey, Elon likes that joke. All right. So let's push through this. And as you could tell, I really put a lot of time into the design of this. We're going to talk real quickly about the structural bottleneck in the global economy. And this is going to be very critical over the next 18 months. So remember, when we came in and joined TheoTrade, one of the very first things that I wrote was called the next 36 months. And if you haven't read it, read it again, because this thesis and this story has not gone away. Basically, the idea here is all roads point to more monetary inflation, how rotation operates in a capital liquidity environment, what the core playbook is. We talked about gold. We talked about silver. We talked about the miners. We've talked about capital efficient stocks, utilities and midstream, diversification across other countries. One of the things that we didn't go too deep on in this, though, is silver and is copper. And copper was one of the primary theses that we had back in March of 2024 when we started to really focus on monetary policy. So just to run you through this and showcase why this is so important. It's not because suddenly people have discovered the London Metals Exchange. It's because every major growth engine, AI, defense, EV, the grid, renewables, are all running into the same constraint at the same time. And for us to actually hit a lot of the demand expectations for things like EV, alternative energy, rewiring the grid, we would need 16 different metals to increase global production by a factor of at least 4. So copper, lithium, silver, zinc, graphene, all that stuff. Some of these things are factors of 10x. I think lithium's a factor of 8. I think that nickel was like 10. Platinum, palladium, graphene is the biggest one, 16x. We have never, by a factor of 2, ever increased. We've never doubled capacity of mining of a particular metal ever in world history in 10 years. So there's going to be structural issues moving forward. Copper's being pulled into high growth, non-cyclical, and structurally compounding sectors. So AI, hyperscale, defense procurement, EV manufacturing, battery plants. We buy a ton of this stuff. Domestic manufacturing, grid modernization, renewables. It is the operating system underneath the next 20 years of global production. So again, 3 to 4 more times than internal combustible engine cars, grid expansion, defense, weapons, targeting systems, copper-heavy infrastructure. The big one, the one that gets all of the headlines, is going to be in the AI data centers. Where did I put this? Okay, never mind. In the AI data centers, new mines take 10 to 20 years, which is just freaking nuts, right? That's one of the major problems here that we have to deal with. But that said, looking at the AI data center, you need heavy gauge wiring, transformers, power distribution, cooling systems, network infrastructure, backup power, heat management. AI data centers, Google, Apple, Amazon, all those names, Meta, Microsoft, they're doubling their data center footprint every 12 months. So that's exponential consumption of a linear supply. Ore grades are falling. There's political risk across the primary mining centers. We have permitting gridlock here in the U.S. Supply can just not meet demand. And if you look at the defense side, there is a massive copper heavy arms race going on in missile guidance, radar arrays, armored vehicles, naval vessels. We're going to start building more ships, munitions, communications, energy weapons. Trump floating the 50% increase in military spending would push the Pentagon budget to about $1.5 trillion. China is expanding its own defense. Japan's rearming. Europe is rearming. Defense spending is not a cyclical thing. It's a compounding one. So copper demand will compound with it. On the EV side of all of this, which I think is critical, a modern home EV charger, like a basic EV charger, uses more copper wiring than most small apartments. That's how much copper goes into this. That's how tight it is. You use about 3 to 4 times more copper than an ICE car. McKinsey's saying about $22 trillion in grid upgrades in the next decade. So every time the grid expands, copper moves. And then there's China. And this is the big one. And this is the thing that I keep arguing that people have to pay attention to. This is the largest copper consumer in the world. They quietly have pivoted toward coordinated stimulus. China launching $1 trillion stimulus, but what you will see, you're not seeing QE. You're seeing targeted injections, property market stabilization, credit windows, grid and power funding, export support, renewed infrastructure loans. China accounts for about half of the world's global copper supply demand, and every time they stimulate construction, manufacturing, infrastructure, the copper margin tightens instantly. The combination's very, very rare. So again, physics does not care about policy. New mines take 10 to 20 years. Ore grades are following. Then we have that political instability. That's very critical. Pointing that out here. This is the trap. Demand wants to go vertical. Supply is chained to geology, permitting, and time. And the market can't respond fast enough. So I want to just simply point out that copper is a macro signal. It is a geopolitical barometer. It is a technology input. It is an inflation thermometer. It is an electrification metric and a liquidity-sensitive asset. It trades ahead of PMIs. It trades ahead of inflation cycles. It trades ahead of manufacturing rebounds. It trades ahead of policy shifts. It is the first asset that will tell you when global growth is reaccelerating. So the world needs more metal than it can produce. And how do you trade this? Well, these are the things that just to pay attention. There's futures, obviously. There's ETFs built around this. The miners really are the pure play. That's FCX, SCCO, Southern Copper, Teck, Rio, BHP. And as I keep reminding you, you don't have to chase any of these names higher. What you can do, which is pretty simplistic, is to focus on how to trade around key moving averages, all roads pointing toward more copper demand. Don't put yourself in a situation where you're trying to chase it and then you give up on the trade. This is going to be something to go with over and over and over and over again for at least the next 2 to 3 years. And the reason is we're still electrifying our grid and China is just starting to print. MLI has remained our highest conviction trade since March 2024. We were in this at around $40. It continues to climb higher. And once again, a metal fabrication company that operates in grid upgrades, domestic manufacturing, HVAC systems, construction, and industrial capacities. We are heavy focused on this. So to wrap this up, Don, copper's the backbone of AI, electrification, national defense. It is the metal. It is the metal that decides how fast the world will grow. These are the key things to keep in mind. Demand is compounding, supply is constrained, China is stimulating, the U.S. is spending, AI is accelerating, defense is exploding, grids are outdated, and EV adoption is grinding upward. It is the perfect combination for a structural bull market. It isn't a trade, it is a thesis, and it is just getting started. I will dig deeper into these trades, how to trade them, how to focus on them, what trades to use, what types of spreads to use, what names. We'll dig into that the last hour. If you are not a member of TheoTrade, sign up right now, name your own price, and get in the room with us. Don will be going live in about 9 minutes. He's going to throw some music on. I will be back, as always, at 3 o'clock. I hope that everybody has a great trading day. Thanks for hearing our story about copper. Have a great trading day.